Hello everyone, and a very warm welcome to this ICAS webinar on tax issues regarding loans and dividends. For those that don't know me, my name is David Mingus. I'm Director of Practice here at ICAS, and it's my great pleasure to once again be your webinar host today. Well, appropriate tax planning for owner-managed businesses and incentivising employees is a key component of the much advice provided by members in practice to clients. Linked to this is that business owners often make little distinction between themselves and their businesses, irrespective of the legal entity type. As a result, loans to participators, employees, and dividend planning are often towards the forefront of activity. If not treated properly, however, then much of the tax planning can be undone either through penalties, an unexpected liability for the taxpayer, or risk claims against the firm and possibly the firm's PII or complaints being made to ICAS. So over the course of this webinar, we're going to be taking a look at some of the key issues and topics in this area, including corporation tax section 455 rules, connected party loan interest rules, employment taxes, benefit in kind rules on loans to employees, and declaring dividends lawfully. To explain and help us understand some of these matters, I'm delighted to be joined today by two tax experts from within the team here at ICAS. Chris Campbell is our Head of Tax for Tax Practice and OMB Taxes. Chris is a Chartered Accountant and Chartered Tax Advisor and joined ICAS after a career in practice owner-managed businesses. He supports members with technical queries and represents ICAS on various HMRC stakeholder groups. Justine Ricomini is Head of Tax for Employment and Devolved Taxes at ICAS, and Justine represents ICAS at several HMRC and industry forums, including HMRC's Employment and Payroll Group, the Employment Status and Intermediaries Forum, and the Construction Forum. And in addition to all of that, is a member of the Scottish Tax Policy Forum, which is a collaboration between ICAS and the CIOT. Before we begin, just a few housekeeping matters to remind you of. You can, of course, submit questions at any time through the Q&A facility, which can be accessed at the top of your screen. Questions can be submitted anonymously, and we will be saving all your questions until the end of the session. Please also join the conversation today through the chat box, which can also be accessed at the top of your screen. And this allows you to comment or discuss with fellow attendees on matters covered by this webinar. We are, of course, making this webinar recording, and we'll be making that available for on-demand viewing afterwards in case you want to refer back to it or share it with others. And finally, the slides will be available on the events page on icas.com website after the event. So as I say, we do look forward to receiving your questions throughout the course of the webinar, and of course we'll try to get as many of those as possible we can do at the end of the time. But I know Chris and Justine both have a huge amount to get through, so I'll pass straight across to Chris to get on with the detail of today's webinar. Over to you, Chris.
Thank you very much, David. Good morning, everyone. Hope you're all well. Just to give a little bit of an overview of what Justine and I are going to talk about today, I'm going to start looking a little bit of a reminder on the corporation tax section 455 rules. Hopefully that'll be a recap for most of you. There might be a few things that you haven't come across. That's on the debit, directors, loan account, loans participators side of things. Before moving on to if there's a credit loan balance and the company is decided to pay interest on that loan. So there's two aspects that I just want to bring you up to date on. One is on the connected party loan interest rules, and the other is on the Forms CT61. I'll then hand over to Justine, who will look at the employment taxes, benefit in kind, and everything you need to be thinking about from an employment taxes perspective, before covering the process of declaring dividends lawfully. It's something we get asked questions about, how to go about it, and what's the best thing to do. And then we'll wrap up with some other practical issues to think about, and there'll be an opportunity to ask any questions you might have at the end. So we'll start first of all with the corporation tax section 455 rules. For those of you who've been in tax as long as I have, you might remember this as section 419 in ICTA 1988. The section number's changed, the act has changed, but the basic rules are very, very similar. There's been a few changes in 2013 that we'll come on to, but in short, this is a tax due for loans from a closed company to a participator, the associate of a participator, an LLP or partnership where the partner is a participator or associate of a participator, and the trustees of a settlement if a trustee, actual or potential beneficiary, is a participator or an associate of such a participator. Now, that's quite a tongue-tied exercise. First of all, we need to remember what a closed company is. So that would be most of the owner-managed business clients I would be expecting our members to be dealing with, because they're either company controlled by its directors or 5 or fewer participators. So a lot of the clients that you'll be dealing with in practice are likely to be closed companies. So any loans from the company to the director owes money to the company or the shareholder. Sorry, I'm using the word director because in practice it's often the director is the shareholder, but the key thing for section 455 is whether it's a participator in the company. So what do we mean by participator? So we look to section 454 in CTA 2010 to give the definition of this. And in short, most people will be a participator because they own the shares or have voting rights in the company. But it can also include a situation where you've got loan creditors or someone who's got the right to receive or participate in future distributions from the company, or entitled to secure assets, income or assets, whether present or future of the company. But as I say, in most cases, it will be the shareholders in the company who you'll be looking at being in scope of section 455. The scope's much wider than just the participators themselves. You need to look at their associates. So this is quite a long list, most of which isn't applicable. The key one on the list is the relative or partner on there, because you could have someone who is got a family member who's owes the company money. They're not a shareholder in the company themselves, but they might still be within the scope, or would be within the scope of section 455. Now, there's a few examples on the slide there which talks about trustees of a settlement. If the participator is a settler, trustees of any settlement where a relative, whether they're dead or alive, of a participator is or was a settler, trustees of any settlement where the participator has an interest of shares subject to trust. Those three categories, it's just designed to catch people who might have been using a trust as a way of getting out of section 455. And the personal representatives of a deceased, if the shares are held as part of the deceased person's estate. And the last point on the slide is a company holding an interest in shares which are part of the estate of a deceased person. That company is associated with any company with an interest in those shares. So that's quite a lot of unusual scenarios on there, but the most popular one, most common one, is either the relatives or if you've got sort of trust involved in some way, shape or form. But we're not going to talk too much about trusts this morning, because we've only got an hour. So if you've got a loan subject to section 455, there's tax payable, and that's based on whether or not the loan balance outstanding at the year end has been repaid to the company within 9 months and 1 day of the corporation tax accounting period. Now, that same 9 months and 1 day is the normal corporation tax payment date, so it kind of goes hand in hand with looking at finalising the corporation tax for the year. Now, it originally started at 25% of the loan balance that wasn't repaid within 9 months and 1 day of the CT accounting period, but the legislation more recently has been changed so that it's actually the dividend upper rate per section 8 of ITA 2007. So that was 32.5% for loans between 6th April 2016 and 5th April 2022. But it increased when the dividend upper rate increased to 33.75% in April 2022. Now, that was all to do with the increase in the health and social care levy. They increased the tax and dividends. They may have abolished the health and social care levy, but they didn't reverse the dividend increase. A little bit naughty there, but that's the rules as they are. So what you might find is, as time goes on, that you're going to have clients who have possibly 3 rates of Section 455 tax being paid, depending on when the loan was originally advanced. I remember when I worked in practice, I had some clients who had loans for a very long time. In fact, I think I actually had a work colleague who was actually as old as the loan. It was that long ago. He was a young colleague, I hasten to add, but nevertheless, you could have clients who've had loans for more than 20 years and therefore maybe have multiple rates of Section 455 payable. Always fun working in tax, isn't it? So the tax is payable if the loan hasn't been paid or released within 9 months and a day from the end of the corporation tax accounting period. Now, I'm not going to talk too much about when it's released, but it's worth bearing in mind that if a loan was released, then that's taxed as a dividend in the shareholder. So I'll just leave that one there. But in most of the cases, it's the loan being repaid that gives the Section 455 refund. So there's no tax payable in the first instance. The relief from the tax is immediate if the loan is paid or released within 9 months and 1 day from the end of the corporation tax accounting period. It's worth remembering sometimes people think that if it's paid within the 9 months and 1 day, it's not reportable. It does still need to be reported in the Forms CT61 supplementary pages, and then you would just claim the relief on in the subsequent page to say that it had been reclaimed within 9 months and 1 day. Being repaid within 9 months and 1 day from the end of the corporation tax accounting period. But if the loan is still outstanding at that point, or there's some bed and breakfasting issues, which I'll come on to in a moment, it would instead be reclaimable from HMRC 9 months and 1 day from the end of the corporation tax accounting period in which the loan is repaid or released. Now, quite often clients find this a difficult concept to understand because they think, oh, I've repaid the loan, that means I must get the tax back. And it depends on the timings as to how quickly. So they do it just a few days before the end of the accounting period. Then yes, they'll have to wait. The company will have to wait 9 months and 1 day. After that, HMRC doesn't like people getting in touch before 9 months and 1 day. But you might find that they just ignore it and tell you to write back if you try and do it before then. Depends who you get, as ever, with HMRC. But in any case, you would record it on Form CT600A, the supplementary page, and make sure that you complete the Form L2P. I have seen cases where people have not completed Form L2P, where there's been a repayment of a loan, and that has meant that HMRC hasn't processed it. It's important to claim the relief within 4 years per Section 458 CTA 2010. It's most cases everyone would be reclaiming it, but I have become aware of some cases where maybe relief hasn't been claimed when it ought to have been claimed. There's been a subsequent advance in the loan and things have got a little bit messy, and it just takes a long time to sort it out. So always best to make sure that things are done at the time, which I think will be in most people's agenda. Now, apologies for anyone who hasn't had their or hasn't had anything to eat yet. The next few slides have got a few pictures of some breakfast, and it's just to visually illustrate the bed and breakfasting rules. Obviously, these rules for Section 455 have got nothing to do whatsoever with actual food. So if I've spoilt your appetite or made you feel nauseous, putting different breakfasts on, I do apologise. But the bed and breakfasting rules cover scenarios where a loan subject to Section 455 tax is paid, and then there's a further, repaid, and then there's a further loan advance thereafter. And I remember being in practice, and quite often we'd have said in days gone by to clients, could you just repay the loan for a couple of weeks and then redraw it again? It used to be perfectly legitimate practice, but since 2013, the rules have changed and the bread and breakfasting rules will apply. And then in some circumstances, the repayment might be allocated against the fresh loan and the Section 455 charge remains. Now, the two rules that we'll look at just now are the 30-day rule and the arrangements rule. If you want to look at these in more detail, you'll find them in Section 464C of CTA 2010. So we'll look at the 30-day rule first of all. This looks at within any 30-day period, there's both repayments of totaling £5,000 or more, either before or after the end of the corporation tax accounting period, and additional loans totaling £5,000 or more after the end of the corporation tax accounting period. And if that is the case, the repayment is allocated against the new loan, and that may mean that the Section 455 liability that the client is seeking to get around remains in charge. So I need to look at the period from 30 days from the end of the corporation tax accounting period to 9 months and 30 days after. And that's because of the repayment, the 9 months, 1 day window for the Section 455 in the first place. You need to look at the period 30 days either side of that. Moving on to the arrangements rule. Now that looks at where there's a larger loan outstanding, £15,000 before the repayment's made, and arrangements have been made for at least £5,000 of new loans to be made to the same person. If you want to have a look at the HMRC manuals, CTM61635 gives some more examples on this. And I would suggest you look at that if you've got a client who might be affected by the arrangements rules. It gives an example of a director who's made arrangements using his personal bank account, personal bank borrowings to loan money to the company, paid to the company to then redraw it at a later date. So that was the suggestion is in that scenario is that it would be caught. There's no time limits for the arrangements rule to apply, so it's not the 30-day rule, but it is for those loan balances that are £15,000 before any repayment is made. There are some exclusions to the bed and breakfasting rules. Thankfully, there are. I remember when I was in practice and these rules were coming in, there was outrage with the tax community at the thought of it. The rules as they were originally drafted would have seen every or most Section 455 scenarios not having any repayment when a dividend was made, because quite often the loan will be repaid by either a bonus or a dividend. And thankfully, the government, before the legislation was introduced, brought in this exclusion at Section 464C6, which is all about if the repayment gives rise to income tax on the participator or the associate to whom the loan is made. So we're looking at things like dividend credited to the loan account or the salary or bonus credited to a loan account. It's important to bear in mind that if the shareholder had rent payable, that's not within the scope of this exclusion, because the revenue say that income it's not taxable income itself, it's form of parts of rental profits. So it's not the income itself doesn't constitute a tax charge. So you would be needing to look at salary or bonus or dividend to be paid direct to the loan account to get around there. If you want to look at more details, HMRC manual CTM 61642 will give you more details there. At this point, I'll just flag up that it's important that any taxed income is paid to the loan account from the same company. So you can't get the exclusion from the bed and breakfast and rules by taking a dividend from a different company and paying it in, or having the dividend paid out directly to the shareholder and then they repay it back in. That wouldn't wash for this purpose. We need to be credited directly to the loan account, which I think in most cases would be how it would happen. Often it might even be a paper exercise. There are some exceptions to Section 455 altogether. If you've got a business that's the company's business is lending money, I would think that would be very unlikely in the owner-managed business client base, but you never know. But one that I have seen quite a lot in practice is the debt incurred for the supply of goods or services in the normal course of business. Quite often I've seen companies and partnerships in the same, they do business with each other, maybe in a similar type of business or complementary businesses, and you might find that there's a debit balance to the partnership at the year end. Now that wouldn't be within the scope of Section 455 if it's on normal credit terms and those credit terms don't exceed 6 months. If they do exceed 6 months or there's longer credit terms that have been offered to regular customers, then normal Section 455 rules would apply. But it is one that I have seen in practice when it comes to loans to partnerships that are connected with the company. The last point on the slide there talks about loans to an employee or director of a company or an associated company. If the loan's less than £15,000, then you need to look at all the loan balances for the associated companies. The borrower works full-time and doesn't have a material interest in the company. So you're thinking about it, if it's a closed company, it's controlled by 5 or fewer participators, but you might find that you've got a situation where one of the shareholders got a really, really small interest in the company, and they work full time, and they've got a small loan balance due. I've seen this in larger owner-managed businesses that I've worked with in the past, that just gets out with the Section 455 issue. Justine will talk about employment taxes, but that's specifically for Section 455. A little bit on partnerships more generally. All change when it comes to Section 455 from March 2013, especially for Scottish partnerships. Those of you who were advising clients before that date may have been able to take advantage of the legal distinction of Scottish partnerships being a separate legal persona, and how HMRC accepted before 2013 that loans for a Scottish partnership were not subject to Section 455. Now, the 2013 changes to the Corporation Tax Act 2010 have changed that. It's broadened the scope. It doesn't matter whether it's a partnership in Scotland or the rest of the UK, it's within the scope for loans after that date. As I said earlier on, it may be possible for a loan to a partnership to be exempt from if it's for the normal trading business of the partnership and the company. What doesn't matter if beyond, it's not the scope for Section 455 might not necessarily just be direct loans to the partnership, because Section 464A, which came in 2013, introduced a new targeted anti-avoidance rule. If tax avoidance arrangements are in place and a benefit is conferred directly or indirectly on the participator or the associate, then we probably could do a webinar on partnership tax issues that you need to be thinking about with mixed partnerships in general. But at this point, I'll just flag up one possible scenario for Section 455 is if you've got a mixed partnership and say the individual partners have got overdrawn capital accounts and the company has got a credit capital account, and then you would find that Section 455 would be payable by the company on the overdrawn capital account aspect. That's something that I think we will probably cover off at a later date in a different webinar, because I think there's a whole range of issues on Section 464A that probably could take the hour in itself. But we've only got an hour, so I'm mindful of time. So if we look on the other side of things, on the credit loan account rather than the debit loan account, Justine, I'll cover the employment taxes aspects on the interest for the debit loan account. But if you've got a credit loan account, you've got interest in the company's accounts on the loan. You've accrued it in the accounts at the year end, but it's not paid at the year end. Now, there are some connected party loan interest rules that you may or may not be aware of, and those apply when the payment of the interest that's been accrued hasn't been made within 12 months. Now, when these rules apply, tax relief is instead given when the interest is paid rather than when it's accrued. Now, the key examples of that are where the debtor is a closed company and the creditor is a participator in the closed company. So Section 375 of the Corporation Tax Act 2009 will give more details. The perhaps less common one, that people are less well known one, is the occupational pension scheme. So the company's occupational pension scheme, if there's interest, so say sometimes it will lend the company money for its normal trading purposes, but might be interest paid on it at the year end. It's not been accrued but not paid. That would be potentially within the scope of these rules under Section 378 of CTA 2009. And for completeness, I don't expect this to apply in many cases, but I have seen when I worked in practice, the connected party loan interest rules apply when the creditor is a company registered or controlled in a non-qualifying territory. Some people might call it tax haven, but it's a list of countries that are classed as non-qualifying. So if it's a company in there and it's one of those countries, then you wouldn't get the relief until it has been paid. So once once the interest is being paid, if you've got individual receiving the interest, there can be Forms CT61 reporting requirements, and quite often people aren't necessarily aware that these exist. I have seen heard of cases where the Forms CT61 requirements aren't necessarily understood. We'll cover them very, very briefly just now. I'm planning on writing an article for ICAS.com to explore these a little bit in more detail, and also happy with anything I've talked about today. It's happy to answer any questions after the webinar. If anything crops up on client work that you need a bit of a steer, happy to get in touch with for you to get in touch with me directly or through the ICAS tax help desk that David will be mentioning later on. So the Form CT61, there's a reporting and tax deduction requirement for payments of interest, royalties, alternative finance payments, manufactured payments, relevant distribution, or similar recurring payment. Now that's the wording from the guidance that HMRC has published. And in most cases, it will be interest, in my experience. And although you might not have tax deducted from your bank interest, if you pay interest to an individual shareholder, pay to anyone, doesn't have to be a shareholder, pay interest to an individual, for example, the company must deduct income tax at the basic rate, which is currently 20%. The payment and the tax deduction is to be reported on Form CT61. And if you realise that you've got a requirement for your client to do CT61, it's not possible to download the form, but you can request it from HMRC, who will then issue a form to complete. Now, there is a link on the website, HMRC website, for agents as well. So it doesn't have to be the company that does it themselves. Sometimes there's some things with tax at the moment that it's the company's got to do it themselves. Agents can still request the form. It will take a few days to come out. Usual HMRC timelines for the postage, and then you can then complete that and submit it to HMRC. And we can't really short circuit it because there's different reference numbers from the usual corporation tax return. And it's important to bear that in mind when you're telling the client how to pay. It's not their normal corporation tax reference. If they use the normal CT reference, it's just going to get filed in the wrong place, and they're going to get a demand from HMRC. So in terms of the CT61 reporting periods, a CT61 return must be submitted for each return period in which a reportable payment is being made. So there's no need to submit nil returns. So if you only got one quarter in the year where there's interest being paid, tax deducted, that's only one return that's needed. Now this will normally be for the calendar quarter, but an extra return is needed if the company's accounting period doesn't coincide with that. So I've used the example there of a 31st May accounting year end. So you'd have the calendar quarter returns, but then the period from April to June has to be split up to the period up to the accounting date, and then the rest of that quarter. So if you look at how that works for a 31st May 2025 accounting year end, you're looking at the month for June, because the month of May split that quarter in the not quite down the middle, but 2/3 down the way, and then you've got the quarter to September, the quarter to December, the quarter to March, and then the 2-month period up to the 31st of May 2025. And for each of those periods where there's a return due and payment required, that has to be submitted to HMRC, and the payment made within 14 days after the end of the period. And that now brings me to hand over to Justine, who's going to look at some of the employment taxes aspects. Over to you, Justine.
Justine, sorry, I think you're on mute. So
apologies. Good morning, everyone. Sorry, David. Yes, classic mistake. It's 11:30. I'm going to get on with it because I can see that time is running away with us again. So let's go to my first slide here. So there are different rules for providing beneficial loans, which are interest-free or at a rate below HMRC's official interest rate, which is currently 2.25%. And also providing loans that you might write off or charging a director's personal bills to their loan account within the company. For beneficial loans, the rules cover beneficial loans which are advanced or arranged, facilitated, guaranteed, or even taken over from someone else by the employer, a company or partnership in the control of the employer, a company or partnership that controls the business, or a person with a material interest in the business. So there's some technical guidance for what can be done in more complicated situations than that, and also for situations using third-party arrangements to make loans to employees, such as an employee benefit trust. So I'll just move on to the next slide. So exempt beneficial loans then. You might not have to report anything to HMRC or pay tax or national insurance on some types of beneficial loans. And this includes things like loans provided in the normal course of a domestic or family relationship as an individual, not as a company you control, even if you are the sole owner and employee. So if those loans are made between two individuals, then it can be exempt. Loans with a combined outstanding value to the employee of less than £10,000 throughout the whole tax year. Loans which are made to an employee for a fixed and invariable period and at a fixed and invariable rate that was either equal to or higher than HMRC's official interest rate when the loan was taken out. Loans which are made under identical terms and conditions to the general public as well. So they tend to apply to commercial lenders such as banks. And loans that are qualifying loans, meaning all of the interest qualifies for tax relief. And there is some technical guidance for an explanation of that. It's quite a complex area in some circumstances. Using a director's loan account as long as it's not overdrawn at any time during the year. So that's a brief description really of the situations in which a loan could be exempt. So I'm sorry for the small writing on this slide, but I needed to squeeze it all in. So in terms of qualifying loans, I'm just going to give a little bit more detail here. There's some guidance at EIM 26135, which is the benefits code, by the way. And this is really sort of section 178 of ITPA 2003. But 178, curiously, does refer back to ICTA 1988, which it replaced. But nevertheless, it's because it's to do with things like mortgage interest relief at source and all that kind of thing. It does hark back to the old legislation. So it's a little bit circular, but bear with me. So if the interest that's payable or would have been payable if the loan bore interest on a qualifying loan is wholly eligible for relief under section 353 of ICTA 1988. And for that, you can see EIM 26136 in the guidance. Or in computing the profits of a trade, profession or vocation as trading income or as property income, then that loan is exempt from the charge on beneficial loans under section 1751 of ITPA 2003. And that's just really to stop it from being a double taxation situation. If only part of the interest qualifies for a relief or deduction, the loan isn't exempt. So it's got to be the whole thing or nothing. The cash equivalent of the loan is calculated without reference to any relief or deductions that are due. And you can see guidance on that at EIM 26200. The employee claims any partial relief due under section 353, so we're back to ICTA again, or makes the appropriate deduction against their trading or property income as a separate matter. So there is an example of that in EIM 26130, and it's example 2. So there are some more examples about the distinction between loans on which the whole and on which part of any interest might qualify for relief, but I'm not going to go into them today. But there is quite a lot of comprehensive guidance on the Employment Income Manual. So in terms of salary sacrifice arrangements, any loans to employees or their relatives which have been made under a salary sacrifice arrangement must be reported, regardless of whether there's a tax liability or not. And if loans are not exempt, as I've just described, then the costs must be reported and national insurance must be paid on them as well. And if the cost of a loan is less than the amount of salary that's actually being sacrificed, then it's the salary amount that's got to be reported and not the value of the loan. So that's just an added bit of complication there for salary sacrifice arrangements. And that was all brought in a few years ago when the salary sacrifice rules were changed slightly to take account of various different circumstances that HMRC had found out about. So let's go on to writing off loans then. Any loans to employees that are written off should be reported on P11D with Class 1 national insurance paid on them. Now that's not Class 1A employer only, that is Class 1. And the reason for that is simple. It's because it's treated by HMRC as remuneration, which falls due under Section 62 of ITPA 2003. So that means employee and employer NICs are due. It doesn't matter whether the loan is classified as a beneficial loan or not. If it's been written off, it needs to be reported. And the benefit in kind value is the amount that you calculate national insurance on. So that's the cash equivalent. And there's a link there to which takes you to the cash equivalent pages of the guidance. So let me move on then to aggregation of loans. All loans must by default be treated separately. I'm just going to put my blind down because I'm going to get blinded by the sun in a second. Hang on a second. That's better. So they must all be treated separately. However, some loans to directors of close companies can be aggregated under the provisions at Section 187 of ITPA 2003, and there's a bit of guidance there in the links. And you have to elect to aggregate loans. So the aggregation election must be renewed on a yearly basis. So you can't just do it once and then think it applies forever. You have to do it every year. And the director is then bound by the decision that's been made by the company once that election's been made. The timing of the election, it's got to be done by the 6th of July, following the end of the tax year in which the loan was made. And so the lender, in respect of 2 or more loans that are outstanding at the same time, where they are a close company and the borrower is a director of the company, the guidance is at EIM 26500, which you can see in the link. And where the company elects to make when the company elects to aggregate the loans, by the 6th of July, the guidance is at EIM 26190 to 92. So that's that for you. So I'll move on to how to calculate the cash equivalent of loans. So this is all bound by Section 182 of ITPA 2003. The normal averaging method gives a reasonably fair result in a straightforward case. So that is the normal route of averaging loans. So that's where the loan is repaid in regular sums, or perhaps the amount of the loan that's being repaid remains constant throughout the year, or the balance of the loan remains constant throughout the year. So it's fairly simple situations, really. So that's when you would use the averaging method. It'd produce an unfair result, though, if the loan fluctuated widely during the tax year. So another calculation can be used instead, because the calculation you're using, the averaging method, could potentially be manipulated, as Chris mentioned earlier, by an artificial sort of bed and breakfasting type of transaction, where the loan is repaid, say, on the 4th of April, and then it's redrawn on the 6th of April. So a second method of calculation, known as the alternative or the precise method, is to be used in those situations. They can be elected by the director or tax advisor who's advising the client, or even imposed by the inspector, who may decide that it's more appropriate to use the precise method. So broadly, the precise method actually involves, so for each day that the loan is outstanding, or loans, if you've got aggregated loans, divide the official rate for that day by 365 and apply it to the maximum balance on the loan for that day, or the total of the maximum balances where you've got aggregated loans. Any interest paid on the loan for the tax year is then deducted to arrive at the chargeable benefit for that year. So it's just a much more precise way of doing it, as opposed to taking the opening and closing balances and basically dividing them by 2, which is the averaging method. So that's that. So the time limit for making an election for using the precise method applies to both the client and the inspector of taxes. So the precise method, the time limit has to be until the end of the period of 12 months, beginning with the 31st of January, next following the relevant year to make an election. So that's a bit of a mouthful. And the inspector has the same period to give that notice as well. So, for example, in the year, say, 2013-14, an election must be made or notice given by the inspector by the 31st of January 2016. So it's expected that employees who wish to make an election for the precise method would do so by calculating the figures in their self-assessment returns on that basis as well. So let's move on to apportionment. So you can't set a loan that's due from one employee against an amount that the employer owes to somebody else, for example, the employee's spouse, because they're not loans between the same borrower and lender. An employee doesn't make a loan to his or her employer by being paid salary monthly in arrears either. If they're only entitled to receive a salary at the end of every month. And there's a tax case on that. It's called Williams v. Todd, and it's 60 TC 727 if you fancy a bit of bedtime reading. So that's a bit about apportionment. So in terms of loans that are subject to aggregation, I wanted to mention that there is some guidance at EIM 26314 where you can work out qualifying and non-qualifying loans and aggregating them together. So that is a subject about which I could happily talk all day, but I'm not going to because we don't have time. So I've put some guidance there for you. In terms of closed companies, the guidance at 26500 and 26505 would help you to decide whether the withdrawals within closed companies actually are they going to be treated by HMRC as loans or remuneration. So that really depends on how regular they are, how much they are, what does it look like? Does it look like salary or does it look like a loan? And the next thing is alternative finance arrangements. So just wanted to mention this because from the 22nd of March 2006, which is, quite a long time ago now, but, time flies in tax. So there are two types of contract under Islamic law, which prohibits, by the way, if you weren't aware of this, it prohibits the payment of what's traditionally defined by Western banks as interest payments. So they're not allowed in Islamic law. So these are now included in the rules for what are known as alternative finance arrangements from 2006. So the first one is a wakala loan, and this is where an investor appoints an agent to whom he gives a sum of money. The agent invests the money on behalf of the principal, specifying the expected investment return. So then the principal then becomes entitled to the return, but nothing more. And the next type of loan is a diminishing musharaka, and the customer and a financial institution contribute jointly in these scenarios to acquire an asset together. And then the customer makes a series of capital payments to that financial institution to acquire the institution's interest in the asset. So these types of loans have been going for many, many years, but it was only in 2006 when the legislation was changed to encapsulate them into the returns and tax the so-called returns as opposed to the interest as if it were interest. So there is no escaping from taxation for those. So if you have clients who are obtaining Islamic finance arrangements, you need to look into these two things because they have grown significantly over the last few years. So I shall just go on to the declaring and paying dividends lawfully. Just wanted to get this one in before we do start the countdown to wrap up for today. There's some good information on the Director Hub, which is on gov.uk. So I've put a list on a link on there, sorry. And before any dividends can be paid out, then I'm hoping that everybody on this webinar knows, but this is just a timely reminder, really. They must be declared and recorded formally. They can be paid out at any time of year, but you can only take dividends from retained company profits. And as Chris quite rightly said, we do get a lot of queries on dividends and paying tax through the query facility. So every shareholder that receives dividends from a company may need to declare the amount to HMRC. But if the company can't afford to pay out dividends, in other words, they don't have retained profits, but those dividends are still taken, then you guessed it, they're treated as loans and they must be paid back. So we're back to the loan rules again. So in terms of dividends for directors, if you're a director and shareholder of the company, dividends can be taken as part of annual remuneration. A dividends part is a payment that a company can only make to shareholders, as I keep saying, if the company's made a profit. But you can't count dividends as business costs when you work out your corporation tax. So you must usually pay dividends to all the shareholders at the same time. And to pay a dividend, there must be a meeting to declare the dividend, minutes, and even if there's only one director, still keep the minutes. Might be talking to yourself, but the minutes are very important. And in terms of dividend paperwork, for each dividend payment the company makes, a dividend voucher must be prepared, which shows the date, the company name, the names of the shareholders being paid the dividend, and the amount of the dividend. There isn't really a set format for a dividend voucher. I always assumed there would be, but there actually isn't. So, you know, for the last God knows how many years, people have been setting up their own templates for dividend vouchers for the most part. You must give a copy of the voucher to the recipients of the dividend and keep a copy for the company's records. So that's a really quick whiz through declaring and paying dividends lawfully. And I will now pass over to Chris to cover off the last few practical issues. Thanks, Chris.
Thank you very much, Justine. We're covering over a number of different issues. Hopefully you're finding these useful. Just a few practical points, just building on what Justine talked about in respect of the dividends and declaring the dividends. First things first is to make sure that you think about the ICAS Code of Ethics and PCRT, the professional conduct in relation to taxation, in respect of any tax planning that you are thinking about doing for your clients. I mean, full stop, but specifically in the context of this webinar on loans and dividend planning. If you do something on behalf of your client that brings about a loss of tax revenue in a dishonest way, HMRC can impose dishonest agent penalties, and that's in addition to the regulation requirements that David mentioned at the start of the webinar. Just to build on what Justine was saying about the dividends aspect, declaring them, as Justine rightfully said, there needs to be distributable reserves in the company, and they need to be lawfully declared at the time. So it is not acceptable to backdate dividends. So you can't go after the company's year end, look at the profits it had, look at the client's personal tax position, and think, oh, if a dividend of X pounds would be really good, let's go back and restate things. That's not allowed. It's very much frowned upon and goes against the obligations of both the Code of Ethics and PCRT. So it's definitely something that shouldn't happen. What you can do, though, is you can do tax planning ahead of the event, so you can have a think about what the tax planning might be. You know, say if the client, a provisional figure calculation, estimate what the personal tax position might be, and then say, well, actually, there would be scope for a dividend of X to be within the basic rate band. And then you can do that in advance and then look to see, are there sufficient reserves to take that tax planning into account before the dividend is declared. But you certainly can't do that after the event. Very, very important to be completely clear on that point. Justine also mentioned, I think earlier on, about spouses having separate loan accounts. From a Section 455 point of view as well, you need to think about, I mean, spouses are independent in taxation, and you need to make sure you can't just carte blanche take one, offset it against the other, or net it off. There's nothing to stop a spouse transferring their credit balance to their spouse to offset a debit balance that they might have, but that needs to be done formally. It can't just be done without it being recorded properly in the accounts. There's other things that you might need to think about on that. And the last point, just it's a query that's cropped up over the last few months, is where you're looking to maybe bring a spouse into the shareholding of a company. It's really important to be careful about how you go about that. I came across a scenario where someone has not thought about the employment-related securities. In short, I mean, we're looking at perhaps doing an employment securities webinar later in the year, and we can cover these issues in more detail. But if you've got a husband or wife or civil partner giving to their spouse or civil partner shares in the company, then that would be there's capital gains tax exemptions, and also there are special employment-related securities exemptions for the transfers as part of the normal course of domestic and family relationships. Whereas the issue of a new share in a company wouldn't be within that. So if, say, your company is worth £100,000 and you issue some new shares in the company and the new shareholders only paying £1, then there could be employment-related securities issues to think about. That would need to go on what used to be called a Form 42. It's now just called an employment-related securities return. It's due the 6th of July after the tax year. Depending on what the company shares are, how marketable they are, there could be additional national insurance issues, and there could be tax for the person buying the shares, so like the incoming director shareholder buying shares in a company that was their spouse. So just flagging it up for awareness at this stage. We haven't got time to cover off in the hour session everything that you can possibly think about in the realm of loans and dividend planning. So, David, I think it's back to you. think you're on mute, David.
I'm doing the Justine trick there, eh? Chris, thanks very much for that, and also to Justine, obviously, for the sessions. I think Justine is going to join us in a second, just as we come to some of these questions. But some really good questions coming in, Chris, which I want to come to you. The very first one, just going back to the original part of the webinar. Can you just remind us again about the CT600 reporting requirements where the loan has been repaid within 9 months and 1 day?
Yeah, no, happy to do that. And a really quite good opportunity just to emphasize the point that there are still reporting requirements. So if the company has a loan to a participator at the year end, you would fill that in on the first part of the CT600A, which talks about loans advanced during the year. And then in the next part of that section of the form, there's the claiming of relief for loans that have been repaid. So sometimes I have seen examples of people thinking you just don't actually need to bother. So they've got the 9 months and 1 day bit clear in their head, but it still has to go in the form, even though there's not any tax payable. Still need to be mindful of the bed and breakfast and rules. So has it actually been repaid within 9 months and a day? But assuming that the loan has been repaid within 9 months and a day, it has to be both recorded and really claimed on the supplementary pages.
That's great. The next question is really around what's considered to be paid and not repaid and such like. And the question is really also around loan interest. So if loan interest is credited to the loan account, is this considered accrued rather than paid?
I think I'd be moving on to the scenario of the connected party loan interest rules on the opposite of the section 455 rather. So I mean this is where the CT61 requirements and the connected party loan interest rules kind of go hand in hand, because if you've got an accrual, then it's not paid. So you've not got a CT61 on the person receiving the interest. But then if you put it to you credit it to the loan account, then it arguably wouldn't be an accrual. It would be the other side of the journal for the expense would be to the loan account. So it wouldn't be an accrual as such, but you would need to be thinking about the CT61 reporting requirements, which would need to be done at that time. Regardless of whether that's within the 12 months after the year end or after, it kind of goes hand in hand with the two. So I've seen examples of clients in the past where there's been a significant ongoing loan interest accrual, mainly because the company wasn't in a position to pay the interest at that time, and then when it did, the company got relief for it through the corporation tax return. But then the other side of it was the director in this case had a personal tax CT61, so the tax was deducted from their interest, and I think they were also a higher rate taxpayer. And that's maybe when you're thinking about the tax overall, you might find that if it's a director shareholder that's got the low interest, they may actually be paying tax at a higher rate of tax than the company's getting relief for. And that's just something just to add in there, just for completeness.
Yep, that's great. Justine, just come to you for a second there. So there's questioning around the employee loans and if it's written off, not by choice, but by way of bad debt. What's the position with employee loans then, and the taxable position of that? And you're on mute now. We're doing great with the muting and unmuting today.
I am. It's not normally one of my faux pas, but it is today, sadly. Okay, so ideally the write-off should be declared on the P11D for that employee, even if the P11D is late, and submitted to HMRC. The Class 1 national insurance would be due on it, because under Social Security law, it's a payment of wages, so it would need to go through payroll for national insurance purposes, and a supplementary return might be required if the payroll deadline's already passed and the payroll's been processed. But the HMRC aren't. When I say they're not overly fussy, I don't want to trivialise this at all, because that's the correct way of doing it. But if an employer wanted to sort of make a supplementary payroll return and just tax the whole thing as salary as a write-off, then at least they're declaring it, and HMRC is getting the money. So really just try and sort of make sure it's declared on payroll or through P11D and payroll. But the strict technical position is P11D and payroll.
That's great. Thanks very much, Justine. Look, we've got a whole load of other questions that we've not got time to go through, unfortunately, because we are now up against the hour time. And while we could run on for a couple of minutes, actually, I think there's probably a good number of the questions that would need a fair amount of time to cover. So to give them their place and to answer them properly, I'm going to propose that actually what we do now is we'll answer all the questions and put them up in a document alongside the slides for today. So Chris, Justine, thank you very much for joining us for today's webinar. For everyone, as always, please remember that you can keep up to date with all the latest tax and other professional news, including the latest information, guides and resources on ICAS.com. And as both Chris and Justine mentioned earlier on, you can, of course, access technical support at any time, any questions that you have in this area, through the ICAS Technical Help Desk, which is also available through the Contact Us section of the website. And that not only covers tax, but also audit and accounting, practice support, AML and ethics queries. It would be great if you could leave us a rating for today's webinar. There'll be a poll appearing on your screens now or in the chat box, depending upon which version of Teams it is that you're using. So we do really appreciate your feedback. So do please take a moment just to rate this webinar before you log off. But before you do so, also I just want to mention, looking ahead, we have a range of webinars which you might want to sign up for. Tomorrow, you can join Jeremy Clark, our Assistant Director of Practice, who will be a panellist on the webinar looking at employee screening, the lesser known essentials, which is one that we're doing jointly with our Evolve Practice Support Programme partner ICAS. And that's a really important area because employee screening does or should form part of your firm's essential part of your firm's fit and proper considerations, and also your employment right to work legal requirements. So that's a good one to join tomorrow. Looking slightly further ahead, I'm going to be back with Chris and James Edwards, who's a tax director at Anderson Edwards, on the 12th of June, when we're going to have a look at tax issues regarding pension contributions. So something to look out for there. And then shortly after that, we're going to be taking a look at the first measures under the Economic Crime and Corporate Transparency Act 2023, which came into force on the 4th of March, when we're going to have an expert speaker from Companies House to have a look at why they've been granted greater powers, supporting evidence, and unpack also some of the changes that are coming forward with the accounting and filing requirements, and what these may mean for you and your clients. And finally, if you want to join us on a face-to-face basis rather than on one of the webinars, just a final reminder that you just have a short time to join up and sign up for the ICAS Practice Conference, which will be held on the 5th of June in Edinburgh, where we're bringing together a range of speakers, expert speakers, to really explore the challenges facing accountancy practices and how to overcome them. So do please sign up to all of those in the weeks ahead. So it does really only leave me to thank Chris and Justine once again for your excellent insight, and of course you, the audience, for joining us on this webinar today. I do hope the webinar has been helpful to you. So until the next time, goodbye.